Today's continuation of our series on 529 plans will cover available options with leftover or unused 529 funds. Some families who are financially able to fully fund a 529 later discover their gifted or athletic child gets a full ride scholarship, decides to join the military, or receives unexpected gifts or inheritance from relatives. While this type of situation happens, one of the most common choices is to have the 529 plan's beneficiary changed to another qualifying family member without any tax consequences. This decision makes sense for families who have one or more additional children who plan to attend college, or for donors who want to help pay for a niece or nephew's private K-12 education. One caveat of using leftover 529 funds is to avoid skipping a generation if you change the beneficiary. This could trigger a tax based on the generation skipping transfer tax known as GST. This tax is applied to 529 plan contributions if the beneficiary whom the funds are transferred to is at least 2 generations or 37.5 years younger than the donor. However, most families will be shielded from this due to the annual GST exclusion of $16,000 per individual and $32,000 for a couple per year. Another option is for the parents to make themselves the beneficiary and use the funds to continue their own education if they desire. If your child decides not to pursue a 4-year degree, it does not mean that they will not need the funds later. You may consider keeping funds in a leftover 529 in the event your child decides to attend college later, continues a graduate or professional program, or pursues a different field of study. Recent changes to the tax law allows the money to be used for student loan payments. The Secure Act allows families to take tax-free 529 distributions to pay off a portion of student loans. Both principal and interest payments toward a student loan are considered qualified expenses. You can withdraw up to $10,000 lifetime limit in qualified student loan repayments per each 529 plan beneficiary and their siblings. Since there is no time limit on spending your 529, it creates an opportunity to leave unused money as an additional legacy to your grandchildren. You may even consider using 529 plans as an estate planning tool. The value of your 529 is excluded from your taxable estate if you retain control of the account. Additionally, you can take a non-qualified withdrawal without paying a penalty on earnings if the beneficiary dies, joins the military, or receives a scholarship which is limited to the amount of the scholarship. You have to pay income tax on any gains in the account. Lastly, you can take a non-qualified distribution. Your contributions will never be taxed or penalized, but any earnings above your contributions will be subject to income taxes and possibly a 10% penalty. Thanks for joining us on today's episode on our 529 plan series. Until our next episode, keep searching for opportunities to enhance your wealth.